All right, everyone, welcome to the Pro Series Part 2, Product Understanding and Examples. I'll be your host today, Jeff Cook. Welcome to the webinar. We got about 58 people here, 59 people here and counting, so we got to get ourselves a good little crowd. Welcome to the webinar. We're going to have ourselves some fun today. Keep it light. For a lot of you guys out here, we're going to have a shorter week. Maybe be off on Friday for Good Friday, so good stuff. So I'm going to go ahead and get started here. A couple of things I want to address before I do. First and foremost, just a little bit about myself. My name is Jeff Cook. I'm a Nadex educator. I have a bachelor in finance and economics from SIUC, go Saluki, Southern Illinois. I got about 10 years of trading experience. I'm 30, so I started right when I was like 20, 21. And I've been here at Nadex for about 4.5 years. Started in 2015, early 2015. So that's a little bit about me. I like to help out new traders, whether it's in stocks or futures or forex or whatever the case may be. It's exciting when people are looking for supplemental income outside of their normal day job. So that makes me happy, and that's why I'm here. A couple of things I want to address. This here is a risk disclosure. Take a minute, read it through. Just a couple of things I'll point out. Trading is risky. Do not fund money with your rent money or your food money or anything like that. And past performance is not indicative of future results. All right. So that is a risk disclosure. Give you a few more seconds to read through that. And moving on. So here's our disclaimer. Again, take a moment to read through it. It's just Nadex's property. Don't copyright it. It's just for educational purposes. That's really what the disclaimer is saying. A few more seconds, I'll let you guys read through that. And I'll go ahead and move on. So this is really going to be the bulk of what we'll be going over today. It doesn't look like a lot, but it's probably going to be a lot of material I'm going to cover. I'm going to really dive deep into all three of these products. So buckle up, pay attention, get out your notepad, because it's going to be fun, but it's also going to be a lot of stuff we're going to go over because I really want you guys to learn the best way possible. Couple other things before I move on. Questions. I have a colleague of mine. His name's Nick. He's right next to me. You can't see him on screen, but he is actually going to be answering questions live and helping me out a little bit with answering questions as I am going through this presentation. Feel free to ask questions at any point in time. I'm also going to be sticking around afterwards after I conclude this presentation and make sure that all of your guys' questions are answered to the best of my ability. So feel free to ask questions, 100%. With that being said, pricing functionality and trade examples of binary options, touch brackets, and call spreads. We have 3 different products here at the exchange. I think it's important to know how they work. So we're going to go ahead and dive in. Oh, and also, I have my Dwayne Wade shirt on today for you basketball fans out there, wearing that pastel pink with the hat. Got to keep it fresh. And shout out to Dwayne Wade. Big fan. Now, let's break it down. So the first thing we're going to go over here is the binary option. And I'm going to keep this slide up here for you guys to look at, and I'll be referencing towards it from time to time. But the first thing I really want people to understand is, like, what is a binary? Well, it's a statement with 2 potential outcomes. So for example, is it going to rain today? Yes or no. And either it is or it isn't. Are the Cubs going to win today? I hope so, but they either are or they are not. So what is a binary option at Nadex? Well, it's still a statement with 2 potential outcomes, only here it's the relationship between the underlying market price, which would be represented by this number right here, this 26,129, right? And the strike price, which the strike price is the number to the right of the greater than sign. Okay, so it's still a statement, 2 potential outcomes. It's the relationship between the underlying market price, where is it currently trading at right now, and the strike price of the option, combined with the time that it has left, which in this case is 1 hour and 38 minutes. All right. With that being said, I'm going to break it down in like so. So true or false statement, it's a yes or no. Either the event happens, either the market's going to finish above 26,110 or it's not, period, at expiration. All right. It's an all or nothing payout. So a binary option contract is scaled at between 0 and 100. At best case scenario, your contract is worth $100 at expiration. Worst case scenario, your contract's worth $0 at expiration. All right. Now, one person thinks it's going to go higher. So in this example here, they either think the market's going to be above 26,110, or you think it's going to finish equal to or below 26,110. All right. And the binary pricing, currently you see that 74.75 here on the buy side and that 67.50 there on the sell side. That's going to fluctuate. That's going to fluctuate as the market, the underlying market, moves up and down relative to this strike price, like the probability of success. And we'll dive into that here in a moment. So a couple of things I want to touch on here. You are a binary buyer if you agree with the binary statement. Do I think that the Wall Street 30 for the month of June is going to finish greater than 26,110 by 4:15 p.m. today? All right. You're buying at a binary trade price and you're wanting it to expire at 100. So if you're a buyer, I'd want that blue number to go up to 100. That's the best that can happen, right? I want that to keep going up. All right. Now you're a binary seller if you disagree with that binary statement. You're selling at a binary trade price, wanting it to expire at 0. So if I'm selling, I want that bid price to go lower and lower and lower and lower to 0. Fair? Now, at expiration, if the underlying market, well, really it's the Nadex underlying indicative price. If it's just fractionally above that strike or more than the binary buyer will receive the $100 contract. It'll be at settlement. All right. And if it's not, then the buyer gets nothing. And the seller receives a settlement payout of $100. All right. Another thing about binary options is it takes some of the emotion out of trading. So for any of you guys that have traded before, maybe setting stop losses or taking significant losses or even significant gains, binary options is a product that takes that emotion out. Because you know your worst case and your best case scenario per contract. All right. So what I'm going to do is I'm really going to break down this slide right here. All right. And kind of go through it. And then I'm going to actually hop onto the chart. I'm going to go to the binary ladder chart. I'm going to kind of show you some in the money, at the money, and out of the money positions. And I'll break that down once I get there. But just breaking down this to make sure that you guys understand how it works. I'll kind of break it down like so. So will the Wall Street 30 for the futures month of June be greater than 26,110 by 4:15 p.m. today? Now, currently the market's at 26,129 and some change, approximately about 19 points higher at this moment than 26,110. All right. Now, if we think the market's going to finish above 26,110 in an hour and 38 minutes, which it currently is, then we would say yes or be a buyer. Now, if we think the market will finish equal to or below 26,110, then we're saying no, or we would be a seller. All right. Note, as a buyer, you have an immediate advantage over the seller. All right. The market is already above the strike price. So the buyer here would have the advantage. The underlying market price is 19 points higher than the strike. And as a result, you're paying for that advantage. So remember, it's 0 to 100 scale. If I was a buyer here, it would cost me right around 74.75 at market price. With a, so if I put in a price order here at 72, I know that my risk is 72, my profit is 28. So I'm risking more to make less in this scenario. I'm paying for that advantage. All right. So looking at the order ticket as a binary buyer, you're risking 72 to make 28. Where if we flip this in terms of the binary seller, the seller is risking 28 to make $72. So the seller is risking less with a larger profit potential, but they're also at a disadvantage because the market is currently above 26,110 and they would need it to be equal to or below 26,110 in an hour and 38 minutes. You're paying for that advantage out of that 0 to 100 scale. What I like to think of is 0 to 100 and also like probability of success, right? 0 to 100% likely to occur. They really correlate and they parallel quite well. All right. And so in fact, what you can do is you can take a ticket like so and basically take the midpoint of the bid and the offer. So here we have 74.75 and 67.50. If you take the midpoint or the middle between those two, all right, that's the true probability of what the market price is reflecting. In this case, it'd be about 71.125%, but who's counting? All right. Somewhere around a 71% chance of success for the buyer, whom has the advantage of the seller, over the seller with about 29% advantage or probability of success, or disadvantage, really, I should say. Now, with binary positions, you do not have to wait for expiration to close a position. That is massive, massive. I don't have to stick in this trade forever. In fact, like just to give you an example, if I bought a binary at $30 and it was trading at $60, I could get out at $60, take that $30 profit, less the $2 in fees, dollar in, dollar out. I'm making a cool $28, and I didn't even have to wait the full time till expiration. That's super powerful. You don't have to wait until expiration to actually make money or lose money. All right. Same scenario, if it was trading at $10 and you got it in at 30 and now it's trading for $10, it's $20 lower than what you got out for. You could take that $20 loss, instead of the possible $30 loss at expiration. So in this case, max loss, if I got into this order when I put in the price of 72, max loss of 72, max profit 78. I know my worst case and best case scenario, and I know that I have the ability to close out of my position anywhere between 0 and 100 as long as there's liquidity on the market. All right, and someone else is willing to take that trade off of you. Another thing to think about with binary options is that depending on the time frame of the market view, Nadex has multiple contract durations to help with your decision. So all your 5-minute binary options traders out there, very, very, very short term. What's going to happen in the next 5 minutes or less? You might get in with 3 minutes or 2 minutes, etc. And that outcome is going to happen in a very, very quick amount of time. We have 20-minute time frames. We have 2-hour time frames. We have dailies and we have weeklies. If you're looking to trade longer than a week, this wouldn't be the product for you. If you're looking to day trade or swing trade, scalp, anything of that nature, is a really solid product for the futures and forex markets. So what I want to do now is I'm going to go over to the monitor here. I believe that's it. So you guys should be able to see the chart here. Hopefully you do. And what I want to do is I'm going to go down to Wall Street 30 here. I'm just under indices binaries. I chose the representation of the Dow futures. I'm going to click on the daily 415 and I'm going to pull up a chart here. All right. And in doing so, I'm going to expand this out. Oh yeah. Looking saucy. So I showed you that ticket before. Now I want to kind of show it to you live, like on a chart and how that would look. So again, if I'm a buyer, I'm going to break down 3 buy positions for you and just kind of give you an example of what I mean. I'm also going to squeeze this just a little bit so you can see a couple more strike prices. All of these different lines right here are representing a different binary option strike price. They all expire at 4:15 p.m. tomorrow. In this example, I'm on the demo platform right now. All right. All of them expire at 4:15 tomorrow, so we have a lot of time left. I don't expect these to move a crazy, crazy amount while we're talking here today. But we know that the market's currently trading right around 26,443 and some change. All right. So if I were to go up here, let's say 26,550, all right, and click on that ticket, pulls up right in front of me. All right. You can see how, as a buyer, my risk is low. It's $20 and some change. All right. And why? Remember, think about advantage and disadvantage. All right. If I'm only paying $20 out of that 100, I'm probably at a disadvantage because I'm under $50 per one contract. Right. So in this scenario, my risk is low. Right. Max loss is $20.50. My max profit's, $79.50. That's almost a 400% return on your investment. But you're at a disadvantage. You need the market to finish above 26,550. And it's only at 26,443 and some change right now. So we need a healthy 100-point move by 4:15 tomorrow for us to receive that $100 payout. Got a couple of options in this scenario. I have a low risk, $20. I know my worst case scenario, I'm going to lose $20 on this trade. I know best case scenario, I can make around 80, but I also have the ability to close my position early. So maybe I get into this now and, 9 o'clock rolls in and, I think the Mueller report's coming out tomorrow, among a couple of other things. We have a shorter week this week. Let's say this market were to fly up, and I really thought that the market was going to be extremely volatile. I could actually, get in for 20 and maybe it's worth 50 tomorrow, or or 35 or $40 tomorrow in the morning, and I could capture that profit and not even wait until 4:15 p.m., which is a really nice thing to be able to do. Vice versa, you take a contract that's like right around where the strike price is at, right? I mean, right around the strike price is right around where the indicative price is. So for the closest one in this scenario would probably be the 26,430 strike price. You see it right there between the blue and red boxes. All right. This is going to probably reflect right around $50 for the contract. And that makes sense once you start thinking about advantage versus disadvantage. We have 23, 22 hours left in this position or in these contracts. And you see the offer and the bid right around that $50 mark. Well, because that strike price is 26,430 and the market's at 26,443. It's 6 p.m. here in Chicago. Market can definitely move a lot right now, but typically think that the Dow would probably, on average, move most, between about 7 in the morning and about 4 in the afternoon, at least here, 8 to 5 Eastern time. Don't expect a lot of movement right now. But you can see if I click on this position here, same thing, breaking it down. This is called what we call an at the money or slightly in the money, I should say now, contract. And the reason why is because the buyer and the seller are both putting in around the same amount, because we're at that 50-yard line on the football field. We really could go either way. The market's slightly above it now, so that's why you see the offer reflect a little bit higher than $50, because the market's at 26,443. We just needed to settle above 26,430. So you got yourself a little 13-point advantage at this very moment. A lot can change in 22 hours for the better or for worse. But we know where we stand. We know where that line in the sand is. It's 26,430. I needed to settle above that to have that contract settle in my favor. If I'm a seller, I needed to settle equal to or below that. A little bit more risk here, but you also have a little bit more of an advantage. Makes sense. Then for all you in the money traders out there, where you give yourself a heavy advantage, like take something like, let's take something like this right here. It's pretty in the money here, all right? But also pretty high chance for success based on where the market is trading at now and with how much time is left. So in this position here, you're saying, hey, I think the market's going to stay above 26,310. Well, it's at 26,441 right now. This thing could come down, about 130 points or so, and it would still settle in your favor. All right. As long as it stays above 26,310, it could settle at 26,310 and some change, and you'd get the $100. Huge advantage in this trade here, but you're also risking $87.50 to make $12.50. After fees, you're looking at $10.50 profit. All right. So not a lot to make, but a huge probability for success, somewhere around about an 85, 86% chance of success based on where the market's at now in relationship to its strike price. So there we kind of broke down the buy side, took a couple of different strike prices above where the market's trading, right around where the market's trading, and and way underneath where the market's trading. So relate that to your trade plan. If you have a strategy, do I think the market's going to move a lot? Do I think the market's going to move a little bit? Do I think it's going to just move from where it's at now and go up? Do I want to have myself a little bit of insurance or a little bit of an advantage going into the position, saying, hey, I don't think at all it's going to settle, equal to or below 26,310. Just remember that the relationship of the probability of success, and remember how much you're paying versus how much you stand to lose and how much you stand to gain out of the 0 to 100 scale. Sell side's just a little bit different. It's just, you're just going backwards, really. You're counting from like 100 to 0. It's pretty confusing for some people to understand, which is totally fine, but they're not really taught to count backwards. Usually we count up. But overall, same scenario here. So here, if I thought that the market was going to go down, I have a lot of different strike prices that I can choose from, all right? And make sure that you choose the right strike price and the right time frame for your expectations. But in this scenario here, I take some, very in the money sell side where, 26,550, and you're saying, hey, I don't want this market to finish above 26,550. I don't think at all that this market's going to settle above 26,550, and I think it'll at least stay below that. Well, if I'm selling, you can see my bid is 1675. All right. I'm not risking 1675. That's what the buyer is willing to risk. If I'm the seller, I'm 100 minus that. And that's represented here by the max loss. So in this case here, I'd be risking 73 or 83.25 to have a max profit of 1675. All right. Not a lot to make, good amount to lose, but I also have, about 100 and what's it, 26,438 right now. So I got about 110 point advantage. This could be a really good contract for you to get into based on your trading expectations if you thought the market was going to settle equal to or below 26,550. And then remember, you always have the ability to close out of your positions as well. Same thing, you take a at the money strike price, something like this, market's at 26,438. We got a strike price for 26,430. All right. And in this scenario here, I'm risking around $47, max profit of 53. I'm right at that. I'm at the strike price and the underlying are about equal right now. It could go just as much up above 26,430 as it could down, right? So, and that's that relationship between that, right, that $50 line. So at the money sell side position here, if you thought the market was going to go down, maybe from where it's at now, this might be a solid strike price for you to choose as an example. And then even more so, hey, Mueller report comes out, jobless claims comes out tomorrow. Maybe you're expecting some bad news in the markets for any way, shape, or form. We're almost at an all-time high right now, by the way. But if you thought that this market was going to come down, a lot, you might put yourself into a low-risk, high-reward situation where I'm looking at something like maybe the 26,310. I'm risking $15.50, and I stand to make 84.50. And that is your, not a huge advantage there. But if you thought that the market was going to go down a lot, then this would be a great position for you to get into. We need the market to come down pretty healthily, about another 120 points or so, or a little bit more than that. But again, if you thought that, then this would be the right product for you. All right. So that really is how binaries work. You have an underlying market, right, where it's at. You have a strike price, what you want it to be above or below. Then you have that price that you're paying, right, versus what you stand to make. Out of that $0 to $100 scale, you can be a buyer or you can be a seller, and you can close out of your position early if you wanted to as well. All right. So that is really a binary option in its full capacity. If you guys have any more questions about binaries, stay in. Nick will answer your questions, and I'll also be here afterwards to answer your guys' questions as well. That's a binary option. All right. Next on the list here is touch brackets, and I'm going to pop over here. I want to break this down here for you guys. So hopefully you guys are able to see this. I'm just going to break it down for you guys a little bit. Touch brackets are our newest product. They came out a few months ago on the exchange. They're only offered by Nadex. Touch brackets are a lot different than binary options in the sense that it's not on a 0 to 100 scale all the time. There's different touch bracket ranges for the different products that we have. But really, to break it down, you have a floor and you have a ceiling. All right. So the floor here would be 2630. You have a ceiling of 26,530. All right. So that's a 500 point range. And ideally, the touch bracket wouldn't exist unless the market was trading inside that range. And the reason why I say that is because with the touch bracket, you're limited in profit and you're limited in loss by the floor and the ceiling. So here, for example, if the market were to go all the way up to 26,530, which it's way down here in this example right now, all right, the ceiling price would knock you out of your bracket. So you wouldn't be in your position anymore. You wouldn't have to worry about closing your position. So you have that understanding of, hey, if I'm in this position and the market ever hits 26,530 and I'm a buyer, my position's going to close. All right. And I would stand at bracket, I would stand to make a profit of about $400. Why? Because remember, we're on a 500 point range here. All right. Every tick or pip, if it's forex, right? Every tick is worth $1. And that offer and that bid is going to straddle the underlying indicative index. All right. So this is the Nadex indicative index. It's at 26,152 right now. The offer and the bids, offer slightly above it, bid slightly below it. All right. So that's your spread. And ultimately, every point that this market goes up, you're making $1 on your touch bracket. Every $1 that it goes down as a buyer, you're losing $1 on your touch bracket contract. Can't lose more if it gets down to 26.30, right? If it hit the floor 26.30, the floor price would knock you out of the bracket for a loss of $100. Why? Because at this very moment, I put a price in at 26.130. It's above all this right now, right? So I put a limit order in. 26.130 would be like a comfortable entry point for me in this example. My max loss is $100. I'm not paying $26,130. A lot of people get confused by that. All right, that number is just a representation of the distance between the floor, 26,030, and where I stand, where I'm willing to get in at, 26,130, right? So my max loss would be $100 because I'm 100 points currently above the floor, all right? My max profit's $400 because there's 400 points between where I got in at, 26,130, and where my max profit is at 26,530, and if that hit, well, I'm out of the trade, and I'm a happy man. Because I made $400 on a $100 risk. Now, same with the sell side. If you were selling, I'm just going to flip this around. If I was selling in this touch bracket, it might not be the best touch bracket to be a seller in because you have a lot to lose and a little bit to gain, but you'll see what I mean. You're just flipping this backwards. You know, I'd be risking around $400 because I'm 400 points below my ceiling. If I'm a seller, I'm protected by the ceiling, and I'm going down, trying to go down to that floor, 26,030. I'd be risking $400 here, and I would stand to make $100 if it tapped 26,030. So that's really a touch bracket. And what's really cool about a touch bracket is that it has a maximum duration of 1 week, and it's a variable payout within that range. So I could get in at 26,130 as a buyer and get out at 26,140 and make a $10 profit, less fees. I'll make $8. That might happen in 1 minute. That might happen in 2 minutes. It might take 3 days. But that bracket will not cancel until Friday, and this week it'd be Thursday because we have a shortened week this week, heads up. But for Good Friday. But you understand that you're going to stay in this bracket, and the value of your position is going to change. But you're not going to be out of your position unless the ceiling or the floor is touched. All right, which is really, really cool. I really like this product. It's a little bit, you have a larger range than a binary. Binary is a 0 to 100 scale. It's all about probability of success. With a spread, you're just trading it as the market moves up and down. The value of your touch bracket is moving up and down. You're just capped in loss and profit at your ceiling and your floor. Okay, so that really is a touch bracket in how it operates on the platform. Couple other things I want to do here, and I made like a funky little diagram here. So if you guys can see this, and we have like, if you ever trade on like Nadex Go on the phone, you would actually see these brackets on the chart. On our computer, we don't have those brackets built in yet. I expect those to be added here over the next couple of months, definitely by summertime. And we'll be adding those actual brackets on the chart so you can actually see your caps on your ceiling and your floor and where the market's trading at within that range. But this is kind of what it would look like. We're going to have 4 touch brackets available at all times. And by the way, if the market ever like hit, like let's say for this example, if the market ever came down and hit this bottom touch bracket, this touch bracket would be gone. All right, and a new touch bracket would be listed onto the exchange. So we're always going to have 4, and you're always going to have different options where the price is close to the floor and you have a lot of room to go up, maybe a good contract for a buyer. You know, the prices are right around in the middle, or the amount that you're risking for loss and for profit are, you know, right around the same. And then you have a bracket that might be, you know, really good for a seller perhaps, where you're protected by that, you know, you're protected by loss by that ceiling, not a lot that you're risking here, and you have a lot of room for it to go down. So just envision touch brackets in that way, and that'll make your brain just relax so much better. I think that's really how touch brackets work. And as you can see, I'm going to throw this over here just real fast. We don't have, that's still the binary ladder chart. So if I go over here to touch brackets down here at the bottom, touch brackets, Wall Street 30. All right. I know where the market's at. I have my 4 touch brackets here, But at this very moment, we don't have like the actual bracket shown on the chart, but that's coming. So high anticipation there. All right. We just know where your floor is. 26,444 is where the market's at right now. Maybe look at something like, ooh, look at that baby right there. 26,310, right? If I were to click on a contract like that, for example, right? Max loss is lower, max profit is higher. I stand to lose 135 here, stand to make 365. Why? Because the market is really close to the floor right now. It's up there by about 135 points higher than the floor. A lot of room to run up, not a lot of room to run down. That floor ceiling is touched, you're out of your position regardless. Or you can get into that trade and sit there and actually, like if I place an order right now, I could, get out of my position, at any point in time. So I'll let that sit there and we'll see where I'm at here a little bit later in the webinar. But that's touch brackets. All right. Next, what I want to go over is our call spread. So this right here is call spreads. Hopefully you guys can see that okay. Call spreads and touch brackets are very similar in that they have a variable payout. Remember, every tick that the market goes up and down, you're making or losing $1 within that range. You have a max loss and a max profit with that floor and ceiling. Same scenario in that regard. All right. The main difference with a call spread in comparison to a touch bracket is with a touch bracket, you are out of your position if the floor or the ceiling is touched, which might be appealing for some of you. If with a spread, you're still using that floor and the ceiling to limit your losses and profits, but you're also, time premium is involved with spread. So for example, if the market were to go down in this example, like below 26,100, I'm not out of my position. Like if I was in a touch bracket, my position would be closed. But in this scenario, I wouldn't be out of my position. Now my contract would probably be worthless because I'm not even in my spread range at that moment. But if you were to compare that to futures or compare it to like maybe getting out of it, getting hit on a stop loss, well, with a stop loss, you just lost money and you're also out of your position. Well, here, can't keep losing money if the market goes below 26,100. Your contract's worthless at that moment, but you still have the ability to allow time to get that market back within that range. Okay. And if you guys want me to go over like spreads in more depth, like afterwards, I can explain this a little bit better. But the biggest thing I can say is that spreads do have a small time premium involved, and it's particularly closer to the wings. I don't want to confuse you guys here, but if the market was like right in the middle of this spread, 26,100 to 26,500 is a 400-point spread. All right. If the market was sitting at 26,300 right in the middle, 200 points to go up, 200 points to go down, the offer and the bid are going to be really, really, really tight right on that indicative price. All right. Really good liquidity, really tight spread between the offer and the bid. And you're also going to have, the closest representation of the offer and the bid straddling that indicative. But if I were to take, like for this example, this isn't the best example in the world, but if I were to take this example, the market has a lot of room to go up and not a lot of room to go down. So if you were a buyer in this spread, you have a pretty healthy advantage as far as allowing, the profit potential to be there and not a lot of risk potential. But you have to ask yourself, well, why would a seller actually want to shake hands with you and get into that trade? And the big thing there is that you can see, and I'll show it to you here on this ticket. See how the offer's at 26,170? It's like 4 points above the current indicative price. Well, max loss in this spread is only $70. I got a max profit of 330. Why? Because I essentially am protected by the floor as a buyer, right? I'm only 70 points above the floor. All right. I'm not risking $26,170. That price is just a representation of where it's at compared to the floor, and that makes your max loss. So market's trading around 26,170. Cool. 70 points above the floor. Great. I have $70 that I can lose. I got 330 that I can make. All right. But I'm paying a little bit more compared to where the actual underlying indicative is, or the indicative Nadex indicative index is 26,166, about 4 points higher than that right now. Whereas the sell side, that's about equal to where it's at right now. So you don't even have to worry about a spread or anything of that nature. You're basically getting for what it is. And if the market was really, really, really close to the floor, the seller would have a little bit of a time premium play that they could utilize, and probably have a bid that would actually be higher than where the current indicative index is actually at. So you're actually in a spread where the market is already below what you got in for, but you also have so much that you're risking on that spread range and not a lot to gain. And that's really how spreads work. Touch brackets and spreads are very similar. Biggest things to take away here are, with a touch bracket, the position closes if your floor and ceiling hit, all right, or ceiling hits. Touch brackets last a week. Biggest thing about spreads is you do have that time premium play, all right, especially on the edges. But we don't have a spread contract that lasts longer than a day. So with spreads, we have 2-hour time frames, we have 8 1/4 time frames, we have daily 22.25-hour time frames, nothing that goes longer than that. Now, if you were to actually hop in our demo platform, you would see, and I'm going to hop over there now, and I talked about this in part 1, but you would see that I believe we are testing out some weeklies as well. At least I seen them up here a couple of days ago. So that's one thing to pay attention to. They're not on our live. They don't exist on our live right now, but I do think we are testing some weekly spreads. So that may be coming soon, maybe not. I know that I have seen them in the demo platform. All right. The other thing I want to touch base on with call spreads is the ranges. So this is like a super old picture that one of my colleagues had sent me, and the reality of it is we don't have those spread ranges built into the charts yet. I have a feeling that will be coming soon, but this is kind of how it would look like, right? This is where the market's at right here, right there in the middle, all right? But we have spread ranges that are really, really wide. So you can see that massive yellow one here, kind of market's right in the middle right now of this floor and ceiling, but that spread range is pretty large, right? 2,700 to 3,300, we're looking at 600 points right there, all right, up and down in total. But then we also have other smaller spreads as well, all right, that maybe last only a couple of hours, or maybe 8 hours, or maybe for the entirety of the day. And you can see, like, in relation, just as an example, like where the market's at in relationship to all these different spread ranges that we have. So if you're looking at trade spreads and also touch brackets, again, just know where the market's at in relationship with the floor and the ceiling, okay? And know how much time you have left. Know your full max risk and your max loss and your max profit, but just have a good idea of where that market's at within those ranges, okay? That's really call spreads on Nadex, all right? You have again the difference between the time frames. Touch brackets last the whole week unless you get knocked out of your floor and ceiling. Spreads only last a day or less, all right? And then binaries, everything from 5-minute binaries to weekly contracts and everything in between. So a lot of different products here, and they all work a little bit differently. Binary options are definitely popular. I talked to a lot of people that trade 5-minute binaries. I talked to a lot of people that trade forex. But I think once you understand how all of these different products work, it might not be the right play to do a binary option based on your expectation. A touch bracket might be a better feel for you, and especially once you know how they work, you can be the most efficient with your available balance and really try to make the best of your trading decisions. Okay. So with that being said, a couple of things. If you guys ever want to give us a call, we have 24-hour client support. They're phenomenal. Our phone number is 877-776-2339. Email customer service at nadex.com. You have questions about your account, email us. That's more than happy to do so if you're not a talker. We also have account specialists here. I'm one of them. I've probably talked to a few of you guys and girls, and I've also had probably a few of you guys on the last webinar. So thanks for coming on in that regard. I appreciate you guys returning. And then also, so give us a call, by the way, 312-884-0162. If you have any questions about your account, particularly like funding, withdrawing, need to set up your bank details, any of those things, I think it's just imperative that you guys give us a call and we knock it out and get it done and get you guys moving on. If you guys have questions and feedback on this webinar, please email feedback@nadex.com. I'm always trying to make this better. I don't want to be worse. I want to really educate you guys in the best possible way that I can. So if you ever want to email that, just to give your 2 cents, I'm down. All right. And that is really going to conclude our session for today. I do want to mention, don't forget to sign up for next week on Wednesday, where we're going to be breaking down the charts in depth, going over the indicators and overlays and customizing your layout and knowing how to navigate through the charting platform. So if you are looking to use the charts here on Nadex, tune in. Next Wednesday, 6 p.m. Central, we'll be sending out an email for the recording along with the registration link for next week. So you'll be guys getting that hopefully, if not tonight, later tomorrow. Sign up for that next webinar next week, and I'll be excited to teach you guys a little bit more about the charts. So that's going to go ahead and conclude our webinar for today. If you guys have any questions, feel free to stick around.